Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB, and it's my pleasure to be with you today, Monday morning, to discuss financial market, what's going to happen next week, but also, and in particular this week, a story about gold. Is gold a buying opportunity after a few weeks of declines, in a stark contrast to overall euphoria that we observe on financial markets? Gold trades below 1800 for the first time since July. So the question is this a good moment to buy? So this is going to be the main story for us today. But before we turn there, a quick look on the other things with top news on the Monday morning for you. We start from Trump's kind of partial concessions. He's still, of course, officially in the fighting mode, but he said should Biden win electoral vote, he's going to leave Oval Office, which is obviously good for the markets, which makes this transition relatively smooth, at least versus expectations that were, really kind of scattered because many scenarios were in play. But probably more importantly, and you see the picture for more seasoned traders, this lady is very well known, Janet Yellen, previous FOMC chairwoman, who was known primarily for unending QE. It's something that markets really love. And if you look at the range of nominations already proposed by Joe Biden, it's pretty clear that he's got full backing of Wall Street, and Wall Street is pretty sure that his presidency will be favorable to them. So that's been a strong factor for risk last week. Other points, a good start of the week from the macroeconomic perspective. We had PMIs from China that were quite upbeat, especially manufacturing improved again over 52 points. So this is a good start for a quite busy week on the macroeconomic side. Cryptocurrencies, we talked a lot last week, especially about Bitcoin, but also alts. I was saying that alts like Ripple, Dash, Ethereum Classic, and the other ones, they could attract a lot of attention. That we saw that happening last week, and that continues. So JPM quant team says that the crypto sell-off could be a dip, but that's not happening right now. So the cryptocurrencies are rebounding, and Bitcoin is once again approaching all-time highs from 2017, but that may happen very soon unless the direction changes. Tensions in the Middle East, that's something that is worth having an eye on, because we had assassination, at least that's suspicion that we had assassination of Iranian scientists that worked on the nuclear program, and Iran says that Israel and the US is to blame for it. So they talk about the revenge, and that's something that you always want to have an eye on, especially after a huge rally in oil prices that we witnessed in November. Calendar for this week, quite intensive one, starting from the PMIs on Tuesday and ISM in the United States. On Thursday, similar indices, but for services sector. And most importantly, it's a labor market week in the US with ADP on Wednesday and NFP on Friday. So after 2 weeks of relatively boring calendar, we have a lot to watch this week. All right, let's move to key markets before we turn our attention to the story of the week, which is gold. But let's start from indices that had tremendous November. November actually was a month when sentiment turned from the very bearish to euphoric. It's quite remarkable. At the end of October, investors literally panicked, given the prospect of a second wave of the pandemic and all the restrictions that followed, and everyone was really scared. So we move 1 month forward, and no one is concerned about the pandemic anymore. We have vaccines in the pipeline. We have economies which are maybe not very robust, but relatively more resilient than they were in the spring. We have very friendly markets for the markets, very friendly kind of political choices and turns with the Biden presidency that was a little bit a concern for the market to begin with, but these nominations that I discussed, and you have them here, they suggest that Wall Street people are in control of the situation. So this is a huge pro for the markets. Then again, of course, you have to weigh that against markets that are extremely, not only extremely expensive. Last week I showed that if you look at price to sales indicator, which is one of the more reliable long-term indications in the markets, US equities are the most expensive in history, whereas here you have Goldman Sachs Financial Conditions Index, which is against the lowest in the history, and that means that the situation is of course bright and rosy, but in such moments when markets are so much overbought, there is obviously always a risk of at least a technical correction. So you should be on alert and keep that in mind. Macroeconomics, two contrasting charts that we have here, and I think that very well reflects the reality that we live in, that for those relatively well, the situation is not so bad as asset prices are on the rise pretty much everywhere, because there's so much money around which is free. You have equities, but also like you can see here real estate getting more and more expensive, and that turns into more activity. As you can see, existing home sales already rising a lot in the United States, a trend that is set to continue in months to come. Whereas on the other hand, on the right hand side, you can see the consumer sentiment is quite subdued, because for a majority of people the situation is not so rosy, which unfortunately is going to be probably a good argument for the Fed to at least stick with current policy or even expand it, even though it leads to furthering of those inequalities. But that's the reality. We have probably not so much control. So it is what it is. Let's turn to Forex, where we have euro dollar closing in on 120, and the question is, can we move above that level in any kind of sustainable manner? From the macroeconomic perspective, there is little argument behind that, because on the right hand side you can see that the yield spread is already closing. What it means that the difference between 10-year bond yields, which was quite huge even at the beginning of the year, it narrowed down quite significantly as the Fed expanded its policy in March, and that created a huge upside for the euro dollar, which was partly utilized during the spring and summer. But now we can see this tendency reversing, because European bonds are really, the yields are really depressed, with the ECB bound to even expand the program in December, whereas the US yields increased somewhat on this vaccine optimism. So from the yield perspective, the upside for the euro dollar seems to be already quite limited. And if you look at the speculative positioning for the US dollar index, you can see that the positioning is negative, which is from a contrarian perspective could be positive for the currency. But what's more important, it seems to be bottoming out. So we had many such situations in the past where such bottoming out usually led, with some of the luck, most of the time, to a rebound of the US dollar index. So from the fundamental perspective, also if you add the fact that macroeconomic data seems to be more supportive for the dollar than for the euro, it looks like there is not so much of the upside on the euro dollar. If we take a look on the chart, it's called, which we turn our attention to in a second, but if we look at the chart, you can see that euro dollar was in this relatively tight range between 116 and 120 for last couple of months, and it's trying to crack the upper limit and go higher. So I wouldn't say that it's impossible for the euro dollar to trade above 120, but like I said, from the fundamental perspective, there's weak argument behind that, but we can see a scenario where traders push higher to cut the stop losses that could be here after such a long period of consolidation, and then reverse back into the consolidation. That would be something that I would say it's quite reasonable. But let's turn our attention to the story of the week, which is gold. Is gold a buying opportunity? Once again, let's start from a chart. Gold, it's over here. As you can see, gold prices have been in decline for quite a while, since early August, where prices were trading above 2070. Gold prices declined by $300 per ounce, and initially it looked like it was just innocent correction. We had this even kind of A, B, C correction. 150-day moving average was well secured here, and it looked like a positive trend could be restored even in mid-October. But then obviously we had this vaccine optimism, which pushed gold prices much lower as this safe haven demand evaporated. And now the question is, with long-term trend, which still seems to be positive, is such a large correction a good opportunity to buy gold? So let's take a look at this from a couple of perspectives. Let's start with a comparison to the previous financial crisis, where you can see a path of gold starting at 100 when the crisis began, and you can see that right now, especially after such correction, we are much lower compared to where this rally took us back in a day between 2008 and 2010. So from that perspective, there is potentially a lot to go. From the fundamental perspective, however, the situation is a bit tricky, because as you can see here, as prices rose over the past couple of quarters, we had relatively weak demand. Actually, the combined demand in the third quarter of that year was the lowest since this data is available, which is the beginning of 2010, as jewelry demand was very weak this past 3 quarters, and central banks were net sellers for the first time since 2010. But without delving too much into it, let's take a look at a key chart from the fundamental demand perspective. As we can here see that it's actually crucial what the ETFs are doing, because obviously you have a lot of other contributors, but if you study a relationship between ETF net changes in gold holdings and price, it seems to be very strong. You can see here that where the ETFs were selling, the price was declining. Where the ETFs were buying, here and here, the price is increasing as well. So it seems like this factor is really crucial for gold prices. And on this chart here, you can see that these ETFs holdings were increasing quite a lot for the past 2 years. So naturally you could say that, okay, maybe this went too far, maybe it's time for at least some stabilization or even a reversal. But then again, bear in mind that central bank policy is not going to change in the near future, and it seems to be the key component, because thinking about alternatives to gold, people can think cash, and if cash has interest rate of few percentage points, after some years it compounds, right, into probably relatively large numbers. So if this interest rate is high, then the alternative to holding gold is very tempting. Whereas if the interest rate is 0, then of course it doesn't compound, because there's nothing to compound. So obviously the alternative to holding gold is very weak, and that's the case right now. And as you can see on this chart, expectations of real interest rates, which is adjusted for inflation, are quite bearish, which means traders, people's investors expect this real interest rates to be deeply negative for a foreseeable period of time, and that's strong argument for gold in the longer run. Gold is obviously not cheap in historical context. As you can see here, this is gold deflated by inflation, which is blue line, and deflated by nominal GDP, which is orange one. And you can see here that even after this $300 correction, the difference really isn't huge, and comparing to means for the past few decades, gold is still relatively expensive, and in fact it's overbought as well. Not so much obviously as it was in the summer, where price was 2 standard deviations here after above the 2 years average, whereas here it's still above the average, obviously much less than it was the case in August, but still the case. So to sum up, certainly gold is not a buy in a short run because we have a downward movement. So from a speculation point of view, you want to stick to the trend, you want to stick to what price is showing you in short run. So if you want to have short-term trading, you either sell or you wait for a trend to reverse. That's my point of view here. But then again, even though gold is not so cheap compared to in the historical context, bear in mind that central bank's policy is not going to change for probably for years to come, and because other assets are also very expensive, and the cheap markets are pretty impossible to find right now, it could be a bit naive to expect gold becoming cheap or becoming fundamentally very attractive before it could eventually rebound. So my point of view here is that if gold prices are about to decline a bit more, probably on a bit of panic selling or something like this, and are about to hover above 1700, or even better, test this zone right here, that could be fundamentally already very, very good buy. That might not happen, as I said, because other markets are very expensive as well. So other investors may think, look, let's not wait until it gets here, let's buy here, or let's buy here, or let's even buy here, because we have a downward limit of this channel. So probably it could very well rebound from here and restore this positive trend. We never know, but as I said, with other assets also very expensive, gold is already starting to look as a bargain from the long-term perspective. So ladies and gents, I hope you enjoyed this video. Please stick to our Xstation mobile platforms, where you can track the markets in the news section, and I see you next Monday on 7:30 again. Have a nice week. Bye.